SpaceX is executing the largest initial public offering in history. They are raising $75 billion, putting the company's total valuation at $1.75 trillion. That price tag makes this single aerospace company worth as much as Coca-Cola, McDonald's, Disney, Nike, and Starbucks combined. Because of the sheer scale of the listing, the company is being integrated into major stock indices. This places the stock directly into the 401k plans and retirement accounts of millions of people who never manually placed a trade for the company. Yet, behind that towering valuation sits a difficult math problem. The company operates at a massive deficit, losing roughly $4.9 billion last year alone. This chart shows the price-to-sales multiples of various major companies. By dividing the $1.75 trillion valuation by their $18.7 billion in revenue, we get a ratio of 95 times sales. Analysts at Morningstar ran these numbers and concluded the company is realistically worth less than half. To secure this valuation despite operating at a loss, the company utilized 3 distinct financial workarounds rather than relying on standard business fundamentals. The first workaround involved a rapid shift in the company's primary business model. A corporation built on launching rockets and satellite internet began positioning itself as a provider of artificial intelligence infrastructure. Management accomplished this by taking Elon Musk's private AI venture, xAI, and folding it directly into SpaceX's primary operations. This maneuver immediately added nearly $2 billion a month in new revenue, secured through massive data center contracts with Google and Anthropic. By leasing out computing power in space, they created what they call an orbital data center business. Renting out high-demand processing capabilities to external tech companies provides a lucrative cash flow that rocket launches alone could not match. The second workaround secured the capital needed to support the valuation. To do that, the company needed index funds to automatically buy the stock. The S&P 500 outright rejected the company's listing request. Their strict rules require a corporation to actually be profitable before inclusion. So the company turned to the NASDAQ, which officially rewrote its own corporate rulebook, abandoning standard waiting periods to accommodate the listing. This fast-track mechanism legally forces funds tracking the NASDAQ 100 to automatically purchase the stock within 15 trading days. It funnels billions directly from standard 401k retirement accounts into the company's valuation. By bending these institutional rules, the company guaranteed an immediate inflow of capital, completely bypassing any skepticism from traditional asset managers about the actual market demand. Even with those automated purchases, traditional Wall Street analysts remained deeply skeptical of the financial math behind the offering. To bypass that professional scrutiny, the company executed a highly unusual third strategy, allocating 30% of the total available shares directly to retail investors. There is a significant catch for buyers. Regardless of how many shares the public purchases, Elon Musk retains 82% of corporate voting rights. This large retail allocation brings in long-term capital from individual believers, while completely insulating the founder from the traditional shareholder oversight that comes with public markets. Some investors feared this forced institutional buying would drain capital from other stocks and trigger a massive sell-off across the broader market. That is not the case. This chart shows the total U.S. stock market. The $8 to $12 billion in forced buying equals only 0.01% of that massive circle. It is a mathematical rounding error spread too thin to crash the market. The actual threat to the stock's stability comes from the inside, specifically the expiration of the 180-day insider lockup period. A lockup period freezes early investors and employees from selling their shares immediately after an IPO. For this offering, that clock runs out in December. This chart shows what happens on that date. An additional 7.5 billion shares owned by insiders suddenly become eligible for open market sale, drastically increasing the available supply. When early investors look to cash out their historic profits, the resulting flood of supply frequently causes severe post-IPO crashes, a pattern previously seen with massive tech listings. Those early insiders need buyers to purchase their massive holdings. The millions of retail investors who bought into the dream simply serve as the exit liquidity, turning this offering into a dangerous financial trap.